Thank you for joining me this evening. Very nice to see you all. And we are streaming live on YouTube as well. So welcome to everybody on YouTube as well. So much to go through. I've made a good study of this to to bring this presentation. So I'm going to keep it as short as possible. But I'm going to go through, I'm going to draw on my experiences of 0708 and the 2000 drop for into 2003 as well. So I'm going to bring all that into focus as well. Look at the underlying goings on in this market. And there's a couple of things here that I think a lot of traders and a lot of people, certainly a lot of people on the street, are not aware of. So I'm going to talk about those and the impact on how that's going to shape my trading and how it could potentially impact on yours as well. Okay, so let's just dig straight into this. As you guys know only too well, no one knows where this market's going next, but it sure is an incredible drop, the likes of which we had never ever seen before. It's far severe, far more severe than 1929. And I'm going to go through with you some scenarios. So I don't know where this market's going to go, but I'm certainly going to go through with you some scenarios where I am plotting for this market to go. For those of you who are watching and listening, if you are not an experienced trader, be very, very careful. Lots of people are asking me, I'm sure lots of people are asking you, where do you think the market's going to go? Should I start buying this? Should I start buying dips now? Now we've come so far, so fast. But if you're not used to this market, be very, very careful, and you should not trade unless you really know what you're doing and you can manage your risk. Volatility is at the extremist ever. So, I mean, like I said, I've traded through couple of major crashes. In 87, I was just trading UK stocks, nothing else, just UK stocks on a value system. And I sold 80% of my share portfolio a couple of days before the main Black Monday, the 87 crash. And the reason why I sold is because stocks were just very, very expensive and price earnings ratios were just extreme. So I got out. Sold most of my portfolio. I also sold most of my .com stocks in about early Feb, late January, early Feb 2000, for the very same reason. When you get cab drivers talking about the stocks, as we did have in early 2000, and .com stocks, they're just going bonkers, absolutely silly. So that's my sort of taxi driver indicator. If it gets as far as the taxi drivers, you know that it's extreme, and the chances are it could potentially not hold. So this is, as you know too well, this is not a normal market. Normally markets sell in a fairly orderly way. This is chaos. The liquidity issue in this market is likes of which we have never seen before. And I'm going to talk to you about, like I said, I'm going to really talk to you about what I think is really behind, one of the most central issues behind this. It's easy to beat your account up. There's not a lot of slides, don't panic, I'm not going to bore you with slides, but I do want to just clarify everything before we really dig into this. So it's easy to beat your account up and make the wrong decisions. At this point, it could be a lot of us are freaked out by what's going on. We're seeing markets are moving in 15 minutes what they used to move in over a week. You're seeing 500, you're seeing 2-minute bars in the Dow with 2, 3, 4, 5, sometimes 500 pip moves. And as a consequence, the brokers are knocking up the margin requirements and knocking up the spreads like crazy, probably making a lot of money. So this is a demand shock. Unlike 0708, where it was a financial crisis. This is a major demand shock, closed up cities. Italy has a major impact, and they are in lockdown as well. And we are about UK is about off of lockdown, possibly 3 weeks, but we are very slow. We've not learnt from the Chinese and the Italians. We're falling into the same traps, and the rates, the infection rates and death rates are beginning to climb much steeper than they could have done otherwise. So yeah, let's take a look at 0708, because I learned a lot from trading 0708, and that's the closest thing we've got here, certainly in my lifetime, because I wasn't around in 1929. And yeah, how do we get there? The banks were incredibly greedy. They, there was at the time in the run-up to 0708, there was so much money sloshing around that banks got very greedy, and they lent to what became known as subprime. But the thing about 0708, I've got 08, 07, 09, it shows you how quick I put this slide presentation together. I apologise. The thing about the subprime was that they not only were these banks issuing debt to people who couldn't afford it and who shouldn't have had extreme levels of debt, they were then parceling it up and selling it across the markets in the form of what became known as securitization. And when I've learned about securitization firsthand, because I had a client who was involved in securitization, as soon as I knew what these organizations were doing, I actually began to tremble. I mean, and the film The Big Short, I absolutely love that film, because I so sympathize. I can just see myself literally freaking out with the level of books that these banks were building up with risky debt. Incredible. Anyway, repossession soared, the banks crashed, liquidity evaporated. Now that's what's happened in the last 4 weeks. Liquidity has just disappeared. One of the things I'm going to do in a few minutes is look at the volumes in these markets, and you'll see exactly what I mean. The thing to sort of stand back and think about 0708 is it took 18 months for the markets to reverse, but it took 4 years for corporate profits to return. 4 years. It wasn't until 2011 when we saw corporate profits getting anything back to near normal levels. But the major criticism of quantitative easing was that the people on the street, the people working at the coalface, as it were, it took over 8 years for salaries to get back. And I was talking to a head teacher the other day, and he was saying, well, he went for 3 years without a pay increase. I forgot that happened. The public sector just didn't get much of a raise at all for a very long time. So in 2009, as we say, central bank stepped in, pumping in billions. Bailouts were extended to the car insurance industry as well as banks and other industries, and it was so severe. The central banks took major action, and it turned around. So now, what have we got now? Well, we've seen this time last week, I think it was maybe not quite on the hour, but we're literally exactly 7 days away from the Fed rate decision. So the Fed meeting that was due to take place on Wednesday didn't happen. We just had a drop to zero rates and a commitment to 700 billion quantitative easing. And we've now even got in the UK, and I suspect the US will potentially follow suit if they haven't already. I'm not fully up to speed with what the US are doing, so bear with me a moment. But we've got salary parachutes where the government are committing to, I think it's 75% of salaries, and I think it's Denmark are gone even higher. But this is not enough, and I can see the central banks and governments putting them hands in the pockets for a much greater level. So let's just pull away from this for a moment and just come back and have a quick look at where the charts are. And so this is a monthly chart of the Dow, and you can see, let's look at the two downturns. Here is the 2000 bubble bursting, and we just ground lower into 03 from a height of 11450 to a low of 7.5. So it's a fairly, and what's significant about this is, compared with today, is the way we just had conventional wave patterns. We dropped, we pulled back, made a lower high, we dropped, etc. So we just had a gentle wave pattern, and even in 0708 is a walk in the park, and yet the story was going around in I think it was autumn 08. Yeah, I think it was autumn 08. There were stories of Wall Street brokers and so on going to the cash point and emptying their accounts because they seriously thought that so many institutions were on the brink that the banks were going to shut all their ATM cash facilities. That's how severe it was, and yet this was nothing compared with what we've just experienced. So we had an initial drop from October 07, we pulled back, etc. And you get the picture. This is a gentle walk in the park, and then there's the QE in March 09, and up we shot. So here we've got this severe plummet of it must be. Well, we'll look at the charts in a minute. We'll actually throw the fibs on this. So if we measure this from the 09 reversal, 18,000 is 50%. So it would, just based on this monthly chart alone, it would stand to reason that we could be looking at a pullback, sorry, a drop, not a pullback, a drop going right into the 18,000 area. And significantly, that takes us right back to the November 16 support, which I find quite funny because obviously that is Trump's election month. So there's a lot pointing on 18,000 at the moment, and we're only 1,000 pips off of that. Well, I'm on Friday, I think, can't remember the exact numbers, but we're probably looking at a round trip of 2,000 pips from the time that we popped up into the end of the Asian period to the open of the European period on Friday to the ultimate late afternoon or late afternoon US drop. I think we're probably looking around, probably more than that. I think probably went up about 1,000 pips and down 2,000. Incredible, amazing. So you can take from that one day alone that to make a week's money, you don't have to jump in and out of this market. I think that's one of my first major points. With the sort of spreads we're seeing and the volatility, you do not have to keep jumping in and out of this. Now, as a day trader and somebody who runs scalper school, that's sort of going against the grain. It's going against the grain because these are extraordinary times, and I can't afford to suggest to anybody that we do conventional scalping and day trading because this isn't a conventional period. Okay, so the other thing, while I've got this chart up, I'm going to isolate that 20,000. I think it's 20,700 was what I was looking for last week from memory. I'm going to isolate that and think hard about how I can get a trade to take that down to 18,000, maybe more. Okay, and let's just go back to the slides now, and then we'll come back to the charts in a minute. Let me just go back to any questions. Keep pumping them into the chat room. So what did I do in 0708, and what can we take from that? What I did was one of the main things I did. I was I always keep a close eye on what other traders are doing. You know, I don't lock myself away and think I'm some fantastic trader and think I know it all. Far from it. Keep very, very close tabs on what everybody else is doing. And there was one particular American trader who I had a lot of respect for a lot of time, who was buying gold from 2005 and accelerated his purchase of gold into the 07-08 period. So I followed track, but not only did I follow track, as a Brit with sterling accounts, it was a double whammy for me because I was buying into an ETF that traded in dollars. So as the dollar and the gold were shooting up, the pound was shooting down, I was doing 40% profit in 24 hours in some stages. So that's now that's at the moment that's not working now. I have traded gold back in the last week, very light trade, not committing all the money, and it did pop up about the day after I bought it. So I got stopped out for literally a small amount of money, and then this popped and the gold popped up the next day. The gold is not the way I'm looking at trading this market at the moment, because we've got, in this extreme situation, we've got assets of all sorts, including the old safe haven of the gold, being sold. Liquidity is so short that we've even got gold dropping fairly hard. And I'll come on to the reasons in a little while, in a few minutes, and talk about, now I do like gold. There's a lot of huge amount of interest sitting on the sidelines in gold. So I think we're getting close to a time when gold is getting ready for a longer term trade, but at the moment I'm just staying put. Anyway, so one of the things I did in 07-08 was to buy gold. The other thing I've been doing ever since 07-08, and I've not stopped doing this, is shorting retailers. I've been a bear raider in retailers for a good few years now, and there's a US stock called Macy's, which is one prime example of that. Macy's, I don't actually know too much about Macy's. To me, it's just a name. It's just a stock. But that was grinding high, and that's had some tremendous waves down. I can't remember the exact numbers now, but I think it's got to about $15, $16, whereas it used to be, must have been about 4 or 5 times that 2-3 years ago. So that's really toppled over nicely. Now, in all this, so I talked a lot about negativity at the moment, and all of us are no doubt getting questions about, should we buy these dips? Some of the prices of what was expensive stocks is now pretty low. Is this time to buy? Well, in certain cases, yes, I am buying stocks, but I'm not holding for very long. For example, we saw BT, and a friend of mine alerted me to this. He said he was interested in BT, so I started focusing on it. It wasn't my pick, but BT is a good solid stock. It ticks a few boxes because of its scale, because of its demand. It's one of these things where areas where demand is increasing. All of a sudden, we've got people working from home, so we've got stocks like Zoom in the US, and other, in fact, we're in a Zoom room now, other providers of online meetings and so on, and online utilities are doing well. In any market that's plummeting and going down, there will be bright spots. So you do not have to throw the baby out with the bathwater, but you just have to be very, very careful and scale down the positions and manage your risk. There are a few other stocks. We've seen Ocado. Ocado has shot up, subsequently dropped right back, I think. But again, so there are bright spots in this. It's certainly not all doom and gloom. And one aspect of this is that I've already touched on, is the stress that you could become under as a trader. Obviously, there's a heck of a lot of stress and panic out there anyway, because got people. In fact, I think my niece works for TUI. I haven't spoken to her recently, but I'm quite sure that she is, at the very least, uncomfortable right now because they've just had 1/3 salary cut, as I read in the paper yesterday. So, but anyway, let me focus back on the main thing here. So, what we've got here is a major demand shock. And the key issue with this is the reason why we're seeing, or one of the reasons why we're seeing oil down at close to $20 last week. I was about to write pounds. The big story behind this is the dollar. That's the big story behind this. And the reason what that is commodities, huge percentage of commodities are traded in dollars. There are massive exchange traded funds that are traded in dollars. Last year, the US economy was far stronger than Europe, far stronger than China. So we already had a big pull towards the dollar even before this kicked off. So when this kicked off, all of those factors combined to make the dollar very, very attractive. So let's have a look at what's happened to the dollar and then talk about what we can think about behind that. So let me call up the dollar index. Bear with me one moment. It is here. So here's the dollar index. Don't worry about these averages. I'm not a big fan of averages anyway, but so we've seen a huge push up in the dollar while gold is struggling. So gold's predominantly trading, a lot of gold is trading dollars, so that's one. That's an obvious reason why this would drop. This is a gold US dollar chart. So we've got a divergent relationship at the moment with a really strong dollar. The safe haven on the dollar is seeing a huge amount of trades, and the fallout is the gold. So the gold is possibly, if this really gets going, it would, and given that we've got such extreme conditions, I could see gold potentially coming down to 1290 or lower at this stage. That's a monthly chart. Obviously we are getting close to the end of the month. So dollar's shooting up. I can see dollar getting a lot higher. If you now look at the pound versus the dollar, we're just coming to a fib level. This is fibbed on 07, 09 range. So we're actually reacting to that 07, 09 range, and here we are. We've literally tested the 127 extension last week to the pip. So I can see the pound getting a lot weaker. I can see that. I think we could we get to parity? Yeah. We're not that far off parity, and the same goes for the euro. We've been under this trend line for since August 08. We've only poked our head above there in May 14 and Feb 18. So that euro, there's parity. This is fibbed from November, late October 2000 to the crisis in April, June 08. These fibs are being adhered to, and so we've got the fib level is literally just a few cents above parity there. So that looks likely. So you could trade these currencies. I'm naturally heavily short the pound anyway because I trade US futures. I think there's a few of you in the room who trade US futures as well. So that's a double whammy if you're trading these US indices in dollars. And because we talked briefly about the oil last Wednesday, I threw up a chart that suggested oil could do $14 a barrel. Well, that would be horrendous for many of these if that's the case. So this chart is looking at we've got major support down here at 19. So 18, 19 is a possibility if this. Yeah, I'm expecting a much bigger downside. So so that could be an option as well. Right, next point. Let's go back to the slides, and then I'll start talking about exactly what we could trade and how. So I think this is as we know, as it's very apparent now, this is a big market shaker, and as with any big market shake like this is going to take time to recover from. Things are going to get worse before they get better. There is no vaccine for this. It spreads very quickly. And one person who's infected in a period of a month would probably infect 200 people. So there's a lot of naivety out there about what's being proposed now here in the UK about locking up pubs and restaurants, etc. My feeling is it's almost too little, too late. Anybody who works in London and has been using the underground, etc. Already we're seeing rates of infection in the home counties, the commuter belts, as starting to creep up. So I really hope that anybody who's affected or anybody who's going to be affected comes off of this lightly and you get just a light flu. The reason why, there's a couple of reasons why this is such a big issue, because not only does this spread very far and quickly, it is, for those of you who catch a bad dose of it, is going to be very unpleasant. It's going to be very high temperatures, hallucinations, all sorts, major sweats, and of course for those people whose immune system is very vulnerable, they are going to get a horrible pneumonia, unfortunately. So that's why the ripple effect is going to be so damaging. Right, if we just climb on. So as traders, so coming back to what they're focusing more on you and I now. So we've talked about the level of the decline, market decline. We've talked about some of these monthly charts and support levels. But let's start to think about what we can do to trade this now. So the first thing is, do not panic. It's very, very easy to get sort of rabbit in headlight syndrome here. It's important that we sit back and think about what we're facing and try and plot a way to make money out of this. As traders, only too well, you can make money out of any market environment. It's a question of how you handle this one in its extreme volatility. Be safe. Stay in contact with the friends and family around you, because that's really, really important. It's not just about trading, it's about life. We will come out of this. We will, even those of us who are going to get this flu, let's hope it's as few as possible, even those who are going to get this flu, are most of us going to recover. So we just need to be very patient, and we need to sometimes, quite often we just need to cut out the rest of the noises around us so that we can just stay focused on what we need to do in this marketplace. So we dropped the fastest and the furthest in history. Liquidity is so slow. We talked about this just recently, but even gold isn't pushing up here, and oil was close to $20 last week, and the dollar's on fire. And as we said, the main reason is so many hedge funds out there that had laid into the dollar so heavily on the back of last year and other factors that now we've got the situation here. Liquidity has really evaporated, really gone off-piste. So a couple more slides and then we'll get back to basics. Talked about this. So yeah, if you can see what's happening on a local level, and the small businesses like restaurants and cafes, now they're shutting. A lot of these businesses work on very short cash flow cycles. Yeah, even bigger businesses have done the corporate share buybacks, and so these corporate share buybacks hit $1 trillion last year. I've not got exact figures on that, but it was about $850 million about this time last year. So I'm guessing, an educated guess, that we probably hit the $1 trillion mark on share buyback schemes. So what does that mean? That means that not only do small businesses have got an immediate withdrawal of revenue, the big corporates, a lot of the big corporates have been stuck with low cash reserves as well, because they got too brazen with their corporate share buybacks. And my other fear about, finally, before we move on to more concrete examples, my other fear about this is pension funds. I just heard a few days ago that my son's in the public sector, he's a lecturer, and his pension fund have just referred themselves to their regulator. They've lost so much money, they just simply referred themselves to the regulator, and they're telling all the people who are using this pension fund that they are going to have to seriously increase their contributions. So the ramifications, the ripple effect on this is absolutely huge. So a few things, key points, and then we're just going to go straight to the charts and just run through some other basics. I've got a typo in here as well. Cash is king. It's going to take well over 2 years to work this out through the system. Yeah, big stocks like Apple, Boeing, Barclays, all sorts. I mean, Boeing is already well under $100. That was a $410 stock not so long ago. Apple has still got huge cash reserves. So at some stage, as that starts to drop into really good support zones, that's going to be a really good buy. EasyJet, I can't believe EasyJet are still paying the dividend levels that they've just announced. They're asking staff to go on holiday and etc. and all sorts of cutbacks, and yet they're still feeding shareholders significant dividends, which I think is outrageous in this environment. I think they need to look after their own people. I think businesses like this, businesses of all big sizes, need to look after their people, because when this does turn around, this does reverse, and it will, those are going to be the people who are going to really help build that business back to previous levels. So if you have not adjusted your trading already, we all need to reset. And I would be the first to admit that I was a little bit slow off the mark on this. Obviously completely reset now, but yeah, I'm trading a lot of the time. I'm trading quarter of my normal size, and to stay in some of these trades, if you really want to stay in these trades for more than an hour or so, you've got to have a sort of double, triple size stop. I'm not holding overnight. I've not held anything overnight for quite a few weeks now. I would suggest if you do think about holding overnight, you've got to have a really good buffer and get your stop close to break even. Maybe just build in a level to try and protect your position. But if you're going to hold this for any length of time, you are going to have to maintain quite a decent stop. I mean, a good bull market, I would hope to see a 300 to 500 pip move in a day on a good push higher. You know, Friday, which is not untypical in today's market, you were seeing 1,000 pip moves the upside and a 1,500, 2,000 pip moves to the downside. Incredible. So smaller size, triple stops. I mean, most days you should be making the same level of profits, even more. And I think the thing to bear in mind is that you just need one good trade a day, or even to do nothing all week and just look at what happens on Fridays. But only do that if you are really, really tuned in to a system that's going to help you manage these big moves. Okay, so at the moment I am, apart from being short the pound, historically anyway, the main thing I'm trading at the moment is just indices, because of what I've just talked about. The volatility here is incredible. I am likely, up till now, I've not traded the S&Ps. I've always traded the Dow for historic reasons. Nothing other than the fact that a mentor that I traded with a long time ago always traded the Dow. So I've never moved from that. But I'm just about to start trading the S&Ps because they're not as volatile as the Dow. I think what's happening with the Dow, or one of the things happening with the Dow, is of course it's got Boeing, and I think Boeing is increasing the moves, the volatility in the Dow. So I would recommend you trade S&Ps. I have been trading, even though this market has been incredibly bearish. As you know only too well, there are some huge pushes to the upside, and in small time frames there are some obvious pushes up. In fact, on the live trading room on Friday, I made 150 pips in about 3 to 5 minutes or something on the upside. Now I actually got out too early because it moved about at least about 350, 500 pips to the upside, but it doesn't matter. I didn't want to get greedy. My aim on Friday was to grab some profit at the open, leave it, walk away, and then potentially, seems crazy now, but potentially have a look at buying it into the close, because we've had some massive short covering bounces on these indices. But of course on Friday, I think the trigger was the statistics for US infection rates. I think that's what it was. But anyway, the trend trade was great, and that moved significantly. Let's just go back to the charts now. Let's just go through a few things that I'm seeing on the charts and a few other markets as well. But again, constantly coming back to this level of volatility, one of the things that's amazing is the way in which the daily charts on the indices are only just sort of touching the 5-day averages. They're not getting anywhere near my favorite 20-day average. They're you've got the 5 or 8 day, it doesn't really matter, there's not a huge difference between them, but they're literally, the markets are coming up to the 5-day average, 8-day average, and just continuing lower. That's all they're able to do over the last few weeks. So we've got some interesting, I'll show you what I'm looking for on a 4-hour chart. But if you are seeing particularly if you're trying to avoid volatility, if you are seeing pullbacks into these averages on the daily chart, then throw open a 1 hour chart and take a look at that, and that should help you avoid a lot of volatility and pick your spots. Right, now I'm going to clear that. I'm going to clear the slides. Yeah, and just take a look at what I'm seeing in these markets. So here's the monthly chart on this Dow, and let's just drill. Let me get rid of this pen a second. So if we drill down to a 4 hour chart, now what I've tried to do in these 4 hour charts is, and I have to admit, put my hands up, at times largely unsuccessful, because I'm trying to be patient for reasonable pullbacks and they're just not coming. Once we got past the early March, the 4th, 5th of March, decent pullbacks to resistance are not happening. Here I was on the back end of the 13th of March, the week ending 13th of March, Friday before last. I came into the markets looking to short 23,300, 23,600, and of course we just fell short of that. We gapped down, of course, and pathetic pushes to the upside, pathetic. So it's very difficult to get short these, but we did, however, have a 4 hour sell signal into midday, and went back to the weekly lows. Drill down to an hourly. You can see, for those of you who know me well, this is what the scalp score system, not the golden anchor, but one of the anchors we use is this hourly chart. I wouldn't ordinarily have so much mess on my hourly chart, but you can see the way in which I fibbed it is to look at the weekly range, and yeah, if you see the previous week's low, this was the key in the midweek. We kept bumping into this 400, and so we got some nice drops. I mean, this drop here, this fib level here, is worth 1,600 pips. I never thought I'd hear one fib level in an hourly chart being 1,600 pips. Actually, it's not 1,600. Sorry, I've exaggerated. It's 1,300. I've exaggerated. So one of the things you could do is, yeah, basic support and resistance. These are very profitable trades. And on Friday, if I need to pull back and clean up these charts anyway, if you see what we did on Friday, I had got this major trend line, 24,000. Back here on this week, I thought we might see 24,000. That's why that's such a major dotted line. But markets are way too weak for that. And so what we ended up with was this trend line. Now, I wasn't actually at my desk to trade this, I have to admit. So I'm feeling really sick about leaving this. This is a trend line that came down from March 4th, March 10th, and we literally hit that right on the nail. It was away. I didn't have any pivots there apart from that trend line, and that hit there at that's actually in the Euro session, wasn't it? Yeah. So we hit that in the Euro session, and then we looked good in the US session in the first hour of trading. We actually had a buy signal, Explains why I went long. We actually ended up with a buy signal on for me in the first hour of trading, first half hour of trading, sorry, on Friday, and then we subsequently just rolled over. Okay, so because these moves are so wide, then drop down to a 30-minute chart, and you can see what I'm doing with this. And the guys who turn up to the meetup rooms will know this only too well. The gap strategies, and particularly intraday, gap strategies are working a treat. This is a intra-week gap strategy. The main, of course, there is intraday strategies as well. Intra-week, I'm looking for the Asian Open of the Dow, and then I'm waiting until we appear to have put it, until we put in a low stochastic on this hourly chart, sorry, 30-minute chart, and then I'm fibbing it. So I'm trying to pick the low of the week. Now I'll show you what I've done. Is the Friday close? That's up here. This dotted line 13th, which is 22,825, and then we Wednesday. So if you then Asian Open with the gap, you can see on Friday morning when I wasn't on my screens, we hit the 50%. There's a lovely trade at that particular stage. Anybody who's into chart patterns would have seen that little three-wave. Now we didn't quite touch the underside of that, but we nearly did. Sell signal at 10:30, and we looked as if we were holding this. It looked quite bullish up until that big lower close on 3 o'clock, and then the rest is history. We didn't quite touch the low of the week, but almost. So I'm using this strategy regularly at the moment with this volatility, waiting till it comes back to my point about you need to be very, very careful not to overtrade this market. There's no need to overtrade it, because if you have a strategy that takes into account these wide ranges, then it should be easier to pick your spot, and this is a really good way of doing it. So I'll just go over that again. I'm waiting, picking off the Friday evening close, not the cash close, the futures close on Friday, and picking off the low of the week and then fibbing it to sell pullbacks. Only unfortunately this pullback occurred when I wasn't watching my screen, and at the open I actually thought that was going to go back up to 21,000, if not during that mid session, at least during the close. So I got that wrong. I did make money, but it just meant I missed a much superior, better trade, more profitable trade. All right. So indices for my money is where it's all at. Forex is much more active, much more lively. I am by default trading Forex, and you saw what I was looking at on the monthly by fibbing that last range. On this daily is fibbed on the 2019 high and low, which I absolutely love that way of fibbing. I find that the fibs on that previous year work really, really well. If you want to set a target for the year end, then I would start using fibs on the previous year. And you can see how when we had this drop on the 12th, we hit the -127 extension. So there's 18,700. Bear with me one moment. My throat's drying up. There's 18,700 on this method of fibs, which I've got in pink, and the monthly chart is saying 18,000, and we have a lot of lower closes. Now one other sort of final technical point on this, these stochastics are very low on this daily chart. They're still sitting up on weekly and monthlies. But just bear in mind that you can, if everyone is sitting heavily short, you can get some nasty short covering bounces and dead cat bounces. So just be aware of that. We've dropped a long way. We're sitting down here very low. It's good to be patient. Let Monday set up. Let the market wiggle around on Monday, and then you can try and pick your spots using 30, 60-minute charts as the week unfolds. So at the moment, I'm steering clear of oil. Let's have a look at gold, because I had started to trade gold last week. A very small scale at the moment. Let me tidy this up. This is a mess. So I'm going to take all this off. It's all old hat now anyway. And yeah, it's interesting, isn't it? I mean, gold was such a massive trade in 07, 08, and yet this has just dropped to the drastic sort of levels that we've seen in indices. So that's interesting, looking at the 19 low where this last big push came from, because that suggests that 1433 is a potential buy zone. If we drop 50%, we're close above 50%, so I'll keep tabs on this, but I think we're at least going to see 1430, and so I'm going to wait, be patient, and see if we can get down to there, and then potentially hold. 14 is just underneath it, and these commodity markets love big numbers, particularly commodity markets. So it's perfectly feasible we could drop all the way down to 1380 as well, 1370, 1380. You know what? I think that's much more likely. I'll keep you posted on gold. I'm going to be doing 60-second daily videos. I'll post that in the meetup as well as the other mail group. But keep an eye on that. Let's look at what's the other markets. Let's look at a couple of stocks. Like I said, I am interested in stocks. That's all I've got to say about indices and gold and oil at the moment, which is a key focus of mine. Let's just look at now. Any questions, let me know. Otherwise, I will just look at what I'm seeing in some of these stocks. Now, like I said, BT was actually a good short-term trade last week. That was, look at this extreme stochastics. Yeah, that was, so we had, that dropped into 102 according to this. So we've gone from 102 to 138. That's not a bad return for 4 days, is it? Yeah, it's a good stock. BT or Openreach own the broadband UK network. So I think this is good for sort of intra-week trade, and I would definitely start picking up 110, 112 if we came down there and held that again. But I would only do it short term, and I would only do it in small size. I'll look at some US stocks in a minute as well. The other one that caught my Ocado shot up. These are, for those of you not in the UK, which we have a few in the room. This is a supermarket delivery company. They used to have, I don't know if they've still got contracts with Waitrose, a big supermarket called Waitrose. Let's go right back. Now, I was a big bear of this for a while. But that's, yeah, so we, from the 12th of March to the 19th, that's a big, decent old run. Gone up, that's gone up 56% from that low. 56% in a week. That's my favorite setup, 3-wave touch. Don't quite touch the 3rd wave. That's my all-time favorite setup. But at the moment that's shorter. Let me look at miners. Might be worth a look. If gold is potentially going to find a bottom, then UK miners might be worth a look. At the moment, not. That's Fresnillo, so I'm steering well clear. I was talking about shorting Next a lot last year in my trading room because I just think retailers are a fantastic opportunity. I'm a bear raider of, have been a bear raider for quite a while. That's my, so this combines the 3-wave reversal with a funnel failure. Any push into that 5,000 would get me interested. Anybody shorting these retailers as well? Anybody had the same idea? So that's any other UK stocks I'm interested in? No, not at the moment. Before I move, I'll just look at the supermarkets. Let's pull up, where's Tesco? Well, here's Sainsbury's anyway. That's really messy. That is very difficult to trade. We gapped up. If I could get interested in this oops, I would nibble on this. In other words, I would buy a small position if we started coming down into that area and held. Otherwise, I'd leave it. Other stocks is a lot of talk about Zoom. See, markets are trashed, and this is still climbing. Note how that 136 is a 161 fib extension. Anybody in the room that does not use fibs? I'm just interested. You know, I know there are a lot of traders out there that don't use fibs. I'm just interested to see if we've got any today. So if we saw 107, I would buy it. I think we might see 119 again. I think that's buyable. I think that could potentially climb to, or it's doubled up, aren't we? We doubled from the October low, more than double. So yeah, like I said, there are good stocks. The other thing is, you know, sectors are really important, aren't they? Well, I have been seeing some potential turnarounds in this healthcare sector. Obviously, you know, this is a virus pandemic market. Now, this organization, Medtronic, don't know a lot about it, but I do know they supply my daughter's type 1 diabetic medication. Okay, so I can't buy that. That's still very weak. Gilead is one that's been talked about a lot. You obviously don't have to be in the US to trade these. Gilead, I think, I've not studied this. I've studied technically, I've not studied the fundamentals. I believe they were talking about virus testing or vaccinations, not sure which. That's why they've hit that resistance high at 82. That's too volatile, so I can't trade that. But keep tabs on the healthcare sector. One final point is that I've got is, what does a reversal look like? If we look at a weekly, wow, that's incredible, isn't it? So there's that 20,700 on this weekly fibs, 20,700. We're getting very shallow pullbacks, so at the moment I don't think we're going to get there, but I'll certainly have an alarm on there if we do. 18.5 is a fib level for this one, and 15,250 is the low. A reversal is going to look like, let's go back to 0708. Extreme, one of the things I would look for is extreme stochastics for a start, and at a minimum you've got to have a weekly engulfing bar, a cloud, and that's what we got on the week beginning March 9th, 09. We had one here, but we didn't have extreme. It was after an extreme stochastics, but that was the trigger anyway. And once we got that, we got some nice simple wave patterns. Got back to normality and had nice simple wave patterns. There's a 5-wave move. And as I've said many, many times, I love Elliott wave. Right, that's all I've got for you at the moment. Now, before you go, one of the things I'm going to be doing is ramping up the membership. At the moment, this is £45 a month, $55 a month. This is going to be the main reason for doing this is the alerts I'm going to be sending out for these trades of the day and trades of the week. So apart from training and the live training room is only for scalper school graduates anyway, only. Take a look at the website that I've just redone anyway, because it's the programs are much more clearly laid out. Just bear with me 1 second. So the membership with all the alerts and the newsletters and the updates are going to be tuned in to what I've talked about and much more. And I'm talking about stocks, gold, oil. So I'm just giving a good overview of what you can achieve in this market. All right, so that's £45 a month or $55 a month. If you want any more information about that, drop me a line. You can email me from the website. Anybody who is not aware of the 3 areas of training we do, starter point is the beginners program. Scalper School is the day trading program. And 360 is global trading. And that covers emerging markets, bonds, as well as European and US stocks. All right, but so the main area to talk to you about was the membership and the newsletter. And of course, for those of you who are in the meetup room, the meetup, the free meetup service, then I'm moving that from Wednesdays to Mondays. So I'm going to look at what the markets are doing on the Monday, start to pin that down to what we could potentially see for the rest of the week, so I can avoid what is Wednesdays is a fruitful day, smack in the middle of the week. Doing a talk right in the middle of the week I found to be a bit expensive recently, because there's so much activity. I'm missing one. There's normally 1 or 2 trades around about that time of the day. So I'm going to back off of that and then bring the emphasis of the meetup room at 6 PM on Monday to trying to pin the markets down based on what we've seen on Monday. Okay, so any questions? And anything else you're looking at? I think there's a lot of opportunities in stocks. Like I said, I've been focused, well, just in case any questions come through, I'll just chat a bit more about what I'm doing on the retail side. Oh, there's Tesco. Yeah, see these in the US and the UK, these food retailers have been doing okay. What's the big one in the US? We've got Walmart, of course. Now, Walmart, in the horrendous storms of Katrina, etc., Walmart was very, very efficient, and the share price is holding up because of that efficiency. And this one is no exception. I certainly wouldn't trade that. I think there's a lot better markets to trade that. But it shows the averages very, very well, considering the turmoil we had in this market, really stable. So it just goes to show you that there are stocks out there that will stack up in this market. Let's look at this one, Helen of Troy. This is one that has been on my radar for a long, long, long time. I've not actually traded that to the downside. There was too much to do in the indices to bother with this. But that, in hindsight, that would have been a great swing trade. So that, where's that going to come? Hang on, let's go back to 18. Let's go back to these 17, 18 lows. Yeah, so it's adhering to that fibs at the moment. It's coming to that. We've got a gap filled down here. That's bar a few cents. That's just backfilled. That's almost backfilled Helen of Troy. So I think the opportunities are, to cut a long story short, I think the opportunities are in the indices and the if there are any bounces in any of these retailers, I will consider shorting them. But there's so much activity and volatility in the indices. I've not been too inclined to trade any of these others. Oh, this is Macy's, $6 at the moment, and that was, there we are. We were. This is a pattern, the likes of which we've just seen in the Dow in 2015. So that hit a high of, there's your three-way reversal up there. On 13th of July, 15. So we touched the high of 73.30, and we just touched $6. It's not, so it's taken quite a long time to get down there, but we had the repeat of that here. So we've had two funnel breakdowns. So that was a high of 41 back in August. Right, I'm done. Doesn't seem to be any questions coming in. So opportunities in dollar if you are in Forex. Otherwise, there are some opportunities for buying stocks if you are looking at good, solid, utility-based organizations that can exploit, that are in demand still, when we've got a demand vacuum in most other markets, like delivery companies, broadband utility companies, and organizations that are on the right side of this pandemic. Otherwise, indices. How do you join the Monday session? You need to join, that's a good question. You need to join this meetup group, which is free, and I'll send you a link. Let me do that. I'll send you a link to the actual room on Wednesday now. All right, anybody who wants to join me on Monday at 6 and is not already registered, register there. Oh, that's private, sorry. Okay, and right, I'm going to break off and do a little bit more prep for the week ahead, but otherwise I'm going to sit tight. See, I assume the market's going to get down again, who knows. I'm assuming the market's going to stay bearish into the next week. There's not a lot of data next week, I don't think. Let's have a look. Got a lot of European manufacturing, US manufacturing on Tuesday, durable goods Wednesday. Yeah, PMIs, yeah. Manufacturing indexes. Otherwise, it's a fairly quiet week overall as far as data level announcements are concerned. Right, thanks a lot for joining me, guys. And I'll post you a video of this, but we need to get obviously a little bit more data out of the way on Monday to see how we can try and pick our way through the coming week. And just be aware, you know, just, you know, there are a lot of people short. If there is a bounce in this market, it could be violent. So as usual, just need to manage our risk and be very careful. Right, thanks a lot. Thanks for your time. Last call for questions. Yeah. Of course, it's Tuesday. It's morning for you, isn't it? Right. Good. Thanks a lot, guys. Enjoy what's left of your weekend, which isn't much. And I will, yeah, thank you very much for attending, and I hope to see you soon. Okay, bye.